only mode.
Sound check, yeah, sound check, yeah. Think now it's okay. Thank you, Lo, for noticing. So, welcome again to Admiral Markets webinar of 9th of July 2014. My name is Nenad, and for all of you who are first-timers here, I'm a head lecturer for Admiral Markets, and I've been doing these webinars so approximately a year and a half. So today we are going to talk about high volatility trading. High volatility is very good for making extra bips, contributing to your own method or system. And I will show you today little tricks how you can make extra pips by using market volatility. And it doesn't matter which method or system you're using. This method is pure price action, and it works on, of course, each of the pair. But there are some rules which needs to be respected because we want to trade high volatility. Usually during high volatility, okay, let me first give you risk disclosure statements, and then I will continue with webinar. So risk disclosure statement stating all the possible risks associated with Forex market. By accepting the risk, you are also proceeding further with me. Online educational materials are developed by Admiral Markets as Estonia for a global audience. Therefore, please take into consideration that information in this session may not be suitable for everyone. To get a corresponding information on charting conditions and any other detail, please visit www.admiralmarketsglobal.com, select your country of residence, and contact an appropriate entity. Admiral Markets UK Ltd takes no responsibility for the information accuracy. The analysis represents the personal opinion of the author. It's me, and in no way it represents the actual suggestion for the trade. These are not MUK's opinions, and the website in the video is not the .co.uk website, but the globalnews.com website. Forex is risky business. This is a personal opinion only, and this webinar is for informational and educational purposes only. So, volatility, non-volatility, because our next webinar will be about non-volatility trading, which I already held for Forex Street, but you will be, of course, next time. I will show you how to trade non-volatility. Today we will talk about high volatility. Then what are advantages and disadvantages of high and low volatility, how to trade it, the strategy and general tips. So direct webinar, very concrete, very straightforward, no nonsense. I will show you price action which was taken from my practical naked trading, and from time to time, I also do that on my Camarilla MACD. It's part of practical naked trading, and it's a great add-on to your existing system or method. Before, as always, guys, always, I told you when I talk about successful trading, I will always mention so-called tripod of successful trading. And today I also spoke with a potential client who was trying to reach those webinars of Admiral Markets, and he has heard that I was doing webinars with Admiral Markets, and before that he didn't know, because he lives in USA, and unfortunately to USA citizens, I have a lot of friends in the USA, but in USA for their customers, for their residents, problem is they cannot move, so they need to move their account outside of US if they want to trade in Europe. So really he was very interested in admiral markets, and he was very keen to trade, but unfortunately at the moment until he transferred his account or whatever outside of US, well, there is no, the rules are just different for USA citizens. And he was, I explained this tripod of successful trading because many people do same mistake again and again. You always need to know that successful trading is based on tripod of successful trading, which includes 3 legs. The first leg is profitable trading strategy. That means a systematic approach based on technical and fundamental analysis. That is what I did to you. If you followed my Admiral Markets blog, Twitter, so on, what did I tell you? I advised you to close your positions because we had a great week. Euro dollar 30 pips, cable 55 pips, GBP 40 pips. Dollar yen was a loser, unfortunately, minus 30, and Aussie was plus 10 pips. So 100 pips pool, and I told you, I advise booking all profits. What that means is I have taken this example because if you want to be successful in trading, you always need to know when to trade. And today FOMC will be held in 2 hours. So guys, even though if you weren't trading today, you know that sometimes not having a position is equal to having a profitable position. So even though if you didn't trade today, judging from fundamental approach, you made a right decision. So maybe you had a couple of scalping trades which were successful. I don't know, maybe you did some trades. But sometimes if you're not sure what to do, if you see that market is very slow, such as today, you just don't trade. So trading strategy not just only contain, I don't know, indicators or price action. Trading strategy is also knowing when fundamental news will hit and when you should stay out of the market. There is no way I would trade during FOMC today. I just don't want to trade FOMC statements. Volatility should be high, and this method, which I will be showing you, you can try to demo it on high volatility. If you see that it's successful, then you go live. I just don't like volatility of FOMC, primarily because it's held in 8 p.m. GMT +2 or 8 p.m. Central European Standard Time. After FOMC, there won't be so big volatility. So that is the only thing, and high volatility trading could be done in all other circumstances when market is very volatile. And I will show you how to do that. But if you think you can try this with FOMC, go ahead, but do that on demo account. Risk management, which is also important. Money management. You know my style of trading. That is why I'm not afraid to show each of my statements to potential clients, because my risk is low. Someone told me that, I don't know, he could make 10% in a single trade by trading binary options. Binary options for me is gambling. My risk on forex trading is very small. I don't trade, for me, euro dollar and Swiss yen are completely the same. I don't make any difference between euro dollar and all other pairs. So why would I trade, I don't know, binary options when I can trade forex market and make profits 3% per month by average? It's not that bad, I think. I always telling you, banks give you 3% per year. If you can make 3% per month, I will tell you that you are a successful trader. But don't come after 6 months to me and tell me I lost my account. If you can make 3 to 4% constantly per month, that's great, guys. That's absolutely great. So don't think that you don't do a good and proper risk management if you earn 3 or 4% per month. Because after a year, your account can be 50% or 30% in profit. And bank would give you 30, only 3%. It's 10 times lower than what you initially made by trading Forex. Of course, we can raise our profits by trading more lots, more volume. Instead of 3%, we could maybe made, I don't know, 6, 7, 8, 10%. But what if there is one unsuccessful month? And that month can be July, I don't know, maybe July. Then all of your profits which you have previously made will be erased. So don't go with high risk. And trading psychology, which is also very important. You need to know when to trade, which market to trade, and not to make any over trading or revenge trading. If one leg falls, all will fall, and your tripod will crumble. So there are no successful trading anymore. Now, to adding to a tripod of successful trading, there is an element of volatility. The element of volatility is basically what gives us the money and what is making us the money in Forex market. Let's say today, let's take a price action today. First, there was a drop, let's say on euro, dollar, and cable. Then there was a rage for 3 hours. And after that, there was another breakout to the upside. But if you take a average true range in account, euro, dollar was only around 30 pips today. 30, 40, that's nothing. So when you see that there is low volatility, there are ways to trade low volatility. We will do that on next webinar. But primarily, high volatility or normal volatility is what you're interested in. The best is if you have normal volatility. So normal volatility means that the price is making this kind of pattern. This is normal volatility. But if you see candles like this and market jumps directly to resistance or falls, that means that volatility has gone up and that we need to be prepared for high volatility trading. So what is volatility? The amount of uncertainty or risk involved with the size of changes in a currency exchange rate. I will give you the best definition. It's how much a price fluctuates over a period of time. That is volatility. If volatility is high, we can say that it's a fast change of price during short time. So the price is going sideways and then suddenly it bursts out to the upside or to the downside, or it may make whipsaws. Don't be confused, guys. This is also high volatility. If you see that charts, market is doing this. That is called whipsaw, and that is very dangerous. But I will teach you how to stay away from whipsaws and trade high volatility but on normal candles. Volatility is usually magnified by the use of leverage. So retail traders usually add on to that volatility because they use highly leveraged market, that is Forex market. Each use of leverage will add to existing volatility. That is why currency trading brings a high degree of volatility. Stock markets are not so volatile, but Forex market is. Stock market has its central exchange, while Forex market doesn't have. So we are talking about highly volatile market. As I told you, the best is to trade on normal volatility. But there are ways to trade both low and high volatility. Minor crosses will usually give a high degree of volatility. If you watch average ATR of GBP OD, or maybe compared to Euro dollar or GBP dollar, you would see that minor crosses are indeed much more volatile than majors. That is what you also need to pay attention to. If you didn't trade any majors before, then maybe it's time to try it by using high volatility method, which I will show you today. What causes volatility? So volatility is caused by every day's high impact news. Well, today's volatility will be caused, of course, by FOMC minutes, then 30 minutes after President Draghi will speak on ECB meeting. So starting from 8 o'clock, 8:30, you will see high volatility in Forex market. So I expect big movements. And that movements can kill your swing trades. I will talk about that later. So that is why I don't like to carry the trade overnight. Swing volatility, high volatility is the worst enemy of swing traders. So every day is high impact news. Each red news. We have Admiral Markets calendar, which we can use with Admiral Markets Supreme Edition also. But I was showing you now Forex Factory calendar. So high impact news are those news which have 3 exclamation marks or they're marked red. So they are usually high impact news. And high impact news will cause a high volatility in the market. Rumors also. You know how they say, buy the fact, sell the rumor. Usually rumors are one of volatility drivers. If there is a rumor today, before FOMC, we could even see high volatility prior to FOMC. So a single telltale can move a market by a bit. And that is why important persons which represents ECB or Fed or Bank of Japan or Australian Reserve Bank should stay away from giving such important news which haven't been confirmed. Because any rumor can move the market. And that is where stop triggering and stop grabbing could begin. Then there are geopolitical events. Ukraine crisis is one of those. Those who traded dollar ruble were probably making a lot of money during Ukraine crisis. Every kind of crisis, each situation which are reflecting on our lives and on countries, big countries, will be reflected to Forex market and currency exchange rates. Macroeconomical news, global news, then natural disasters. Try not to think of it, but if you want to think about a disaster, remember what an earthquake did to yen some 3 years ago. Many people have lost their accounts during that time. Really, many people have lost their accounts. Central bank interventions also. Just remember, I will show you now a central bank intervention. Let me find you an example of central bank intervention. Open up a daily time frame, or let's say monthly time frame, and you will see clear sign of central bank intervention. If you remember, when euro-dollar tanked, this was the time when euro fell to, look at the lower bottom, 1.1875. And that time, look at the monthly candle, guys. Almost 1,000 pips. And look at after that. All those things were caused by central bank interventions. If you zoom it in at this particular time, you can see that the daily range was also huge, and that was caused by central bank interventions. Look at the daily candle. Bang! That's strictly a sign of central bank interventions. And those kind of things will usually happen when a country wants to strengthen or maybe lower the power of their currency. If currency is weak, then the country obviously needs to strengthen the currency. Because if the currency is weak, that can cause inflation. And when currency is strong, they need to weaken it, and because a strong currency can cause a deflation. So central bank interventions are common in forex market, but they only happen when price reaches extremes. So don't think about euro-dollar tanking to a parity anytime soon. Profit taking also, it's a cause of high volatility. The simple explanation of volatility, high volatility. Let's say that this is important resistance intraday, and this is important support. And let's say that the price was fluctuating between those two, and that intraday resistance is also a monthly resistance, which is basically a confluence of intraday and monthly resistance. Now, once the price breaks through this level, usually it will collect some stops, moving to next resistance. If important support and resistance levels are broken, that will mean that there is stop grabbing, so it's add-on to the profit taking, so it's stop hunting or stop triggering. And now all those buyers which were basically, those are not fresh buyers. We only talk about stops which were triggered above monthly and daily and intraday resistance. Now, those stops will lead to next resistance levels where we could see selling, because many of those longs who initially came in when the price broke through resistance will close their orders. Each close of a buy is automatic sell into the market. So when buy orders are closed, that means that your platform did an automatic sell into the market. So profit taking will lead to retracement. And that is what we saw with dollar yen. Unfortunately, dollar yen really broke out of that resistance, but it didn't make a next swing at the point which I was thinking it would be, but it was stopped short around 50 level. So basically, profit taking can lead to unexpected price behavior. And usually the first form of profit taking is spotted during each Friday, because Friday is a profit taking day. London noon especially, London traders take profits around London noon, and USA traders usually take the profits just before London closes, but they can carry over with some trading after London close. But if you watch market conditions, you probably know that, and you probably saw it, that when Friday comes, usually 80% of trading will stop after London closes. So that means that a partial profit taking has taken place. Now, what are the advantages of volatility? So, as I told you, in order to make money, volatility should be present. Normal volatility is the best, but high volatility and low volatility can be traded. Volatility will give boost to our entry, turning it into a profit zone. So let's say that you want to trade, I don't know, cable long. You have entered there, you put your stop loss here, and your first target there. But sometimes huge volatility can give you a great position, even going above your first target. So that means that your first target will be hit in a few minutes. Also, that high volatility can give you a nice retracement entry. Let's say that we are in uptrend, but we cannot get a good enough retracement to go in. If there is a high volatility, that can lower the price, and then you can buy it at a better price later. So volatility will give boost to your entry, turning it into a profit, but it also can give you a retracement to buy into. I don't need to mention how important it is in scalping, because scalping is much easier. It's a lot easier if you do it on high volatility market. But you can go and you can scalp with low volatility, but your trades could be much more successful if you go with fast scalping trades. I already showed you how to turn scalp into swing scalp and swing scalp into intraday position. If there is high volatility, you can turn your positions, scalping positions, into scalp swings and subsequently into intraday positions. Scalp swings, instead of making 8 or 10 pips, you can make 20 pips. You already know how to do that if you watch the webinar. Intraday, direct rise or direct fall. This is direct rise from the support directly to next resistance, and this is direct fall directly to next support. So direct rise and direct fall do not follow trend zigzag pattern. Direct rises and falls are usually done with high momentum when the price reaches one level of resistance or two levels of resistance without making any retracement in between. Momentum trades, if you like to go with momentum, you will go with breakout trading. Momentum trades are breakout trades, and those really are dependent of good volatility. Because if you go with a breakout on low volatility, you will lose. And I can guarantee that you will, 70% of the time you will lose. So never ever try to go breakout, try to trade breakout when you see that, I don't know, there is very low volatility, there is a bank holiday or something. Because usually the price will go outside the triangle, well, I don't know, for some amount of pips. But usually it's a small amount of pips. And then it can suddenly reverse. So momentum trades are very important for volatility. Because you cannot do momentum trades without volatility. You can go low volatility trades. But those are not the same as momentum trades, which I will be showing you today. Momentum high volatility trades. reverse positions from long to short and vice versa. If you can take a log at the support, but you suddenly see that the price breaks through that support, you can go with trigger happy trading and then basically close your buy and open your sell. And usually your sell will go initially in some profit. And breakout trading, standard breakout trading, triangle breakouts, flags, wedges, pennants, whatever. Breakout trading is all about volatility. Low volatility can be traded by mini retracements. I will show you that on low volatility webinar. But if you want to do breakout trading, you need to be sure that there is a proper amount of volatility present in the market. And when I say the market, I specifically refer to a currency pair. So euro, dollar, cable, GBP and CAD Swissie, all of those pairs are markets. Euro dollar is one market, cable is second market, and so on. Disadvantages of volatility. Over trading. First and the worst nightmare besides revenge trading is over trading. If you want to overtrade, then you don't have a good psychology, guys. You need to admit that. If you're overtrading, that means that you are exceeding your maximum risk. Why would you do that? If you made profits from this day, switch off and try to see if market gives us a chance on the next day. Revenge trading. All of us have passed through the phase of revenge trading. Revenge trading can be really a bad thing to do, especially if you're a new trader, because new traders will lose money if they do revenge trading. Gambling. If you see that the price is moving fastly, eventually you won't follow your system or method and you would place double lot size trade, and that is gambling. Swing traders especially, I told you, suffer from huge volatility. Swing traders who keep their positions overnight and make their decisions according to the daily chart are those who suffer from extreme volatility situations. Usually there is not a clear trend. There can be gaps which are open every day, and stop loss orders are triggered close to positions. So keeping positions overnight in extreme situations is much more riskier than usual, and you would already want to avoid that until that storm of volatility fades away. High volatility is big celebration for me because I am intraday trader. I can make quick trades, ride on high range momentums. I can reverse from long to short and vice versa. But it's great advantage for day trading. But again, I need to remind you, you should never overtrade and revenge trade when you are day trading. You shouldn't do it ever. Forget about it. Low volatility trading is something different. It can be traded on lower time frames, in contrary to high volatility trading, which can be traded on each single time frame. But of course I use 1 hour, and I will show you how to trade with 1 hour. Now, as I told you, volatility can bring you whipsaws on every time frame. Whipsaw is when the price is making this. Up, down, up, down, up, down, so you don't know where it will go. It's not the same as range trading, because in range trading you will have a calm price action. But if you see that the price action is fast and you don't know which direction it will go, then it's a usually sign of whipsaw high volatility market. You want to trade high volatility only if the market is calm enough, not wild. And traders who don't trade 20 pairs or more may suffer a lot, because one day you won't see any volatility from euro and cable, but you just don't know which other currency pair you might trade. So you can get basically in the trap. Trading only euro dollar is just for novice traders. If you want to be advanced or pro trader, you need to trade more pairs, believe me. Now, how do we do that on volatility? I will show you now. So open first is to open up your 1 hour chart. Okay? And yes, one more thing to add before I forgot. Cross currency minor pairs is good thing to go if you trade volatility and you want to trade volatility. Currency pairs which are minor crosses, including exotic crosses, they naturally have low liquidity. Trends can be found in these pairs, and they tend to be influenced more than fundamental outlook of the country than risk on, risk off sentiment. So guys, always pay attention to that. Okay, so let's move on to volatility presentation. So just I will give you a few seconds to print screen your this slide, so you can use it if you get stuck. But it's pretty straightforward, and the method is, I don't know if other traders trade it. This is how I did it. So I don't know if this is my method, but this is how I did it without anyone teaching me to do that. So I will give you a few quick seconds to memorize the screen. So draw fib in the candle direction. Entry should be around 61.8 or 78.6. Remember, these are important numbers in Fibonacci trading. Marubozu candlestick should have at least 25 pips in itself, and it usually happens after a breakout or if you bought a support resistance level. So these are white Marubozu candles. Bullish candles or bully candle usually mark strong buying into support or resistance breakout. On high volatility trading, we want to see Marubozu candlestick, which is at least 25 pips from the open to close. Sorry, from high to low. It needs to have at least 25 pips from high to low, and it needs to be a Marubozu candle. These are white Marubozu candlesticks, and they are used for long entries, and black candlesticks are bearish Marubozu candles. Three types of Marubozu candles. And sometimes we can even trade if we see both wicks to the downside, but not very long. That also indicates a high volatility in the market. Now, this is pretty straightforward. Draw your Fibonacci from this point to this point here. So you're basically trading volatility, and you're trading the single candlestick pattern so-called Marubozu candlestick. Just look at where that entry had gone. First, this is the first touch, and you could have made some 25 pips. And this is the second touch, the third touch, so 3 chances for a good volatility. This is Marubozu candle, a bullish, strong momentum candle, and I usually trade those candlesticks alone. I don't need anything. Now take a look at the second picture. Look at this. It doesn't matter. I draw the Fibonacci like this, but you can make Fibonacci from this point to this point, and it would be the same. The price would still pause close to 61.8 at 78.6. Look at this example. Yeah, the example of New Zealand dollar. Strong volatility candlestick. Look at this. I do that on 1 hour time frame. I don't change time frames. So I always do it on 1 hour time frame. Look at the candlestick. Now a newbie trader would probably go short around here. And that is why you have me to explain you that you should never ever do that. And look what happened after. The price touched perfectly 78.6. And also in between, there are no less than 25 pips. And that is also a very important rule. Because if one candlestick has more than 25 pips, it's considered high volatility candlestick. And we want to see Marubozu. For buying white candle, for selling black. Look at where the price rejected. Exactly at 78.6. Exactly at 78.6. 2 times, guys. 2 times. So that is how I do that kind of trading, guys. That is how I do it. So let me open up this chart. So it doesn't matter. We can try to search for those candlestick patterns, guys. We can try spotting those momentum candlestick patterns. Even this candlestick here is a momentum. And you can look at this example. Exactly at this point, very, very close to 61.8. The price was rejected for, well, almost, guys, 60 pips. Oh, sorry, this is daily. Okay, daily. I don't trade daily. I look hourly. But look at this. It's a good example. Let's get on to hourly. And this is a good example. This is high volatility candlestick, Marubozu. You don't know which one is that, just refer to the webinar. White opening Marubozu. Is there more than 25 pips in it? High to low? Indeed. But look where the price went, to 38.2. Now we are interested to trade it either on 61.8 or 78.6. Only if the price touches 61.8 or 78.6. If you want to trade that, then remember that your stop loss should be below. So if you traded this from this point, your stop would be 20 pips. If you have taken your trade around 78.6, your stop would be 15 pips. What is this? What candle is this? Open up again. White opening Marubozu candlestick. Look how good it is. Fibonacci from this point to this point, where the price stopped at 61.8 and few pips above 78.6. 2 pips only. Look how good this kind of trading is. But you need to wait. You need to be patient. And that is what I have told you today, guys. Be patient. Don't rush in your trades. If you miss a setup, try to find another setup. And this is how I do high volatility trading. Let's find another good example. I particularly want to see this kind of candlesticks with very, very low, with low wicks. I don't like to see wicks. Concerning your TP can be first at the height of Marubozu. Your first TP could be there, but then you need to also watch for second TP because we have a high volatility. Usually when this resistance is broken, next resistance will touch. So you need to watch for another resistance also. But I do it on trailing stops, so I particularly can have full position trade, I mean full target position trade only if luck gives me that high volatility. Because I've been extensively using a trailing stop. That is what I also teach with Camarilla MACD. And usually when I see that the price is, I don't know, 15 or 20 pips in profit, I would move my stop to break even or break even plus 15. So that way I will secure 15 or 20 pips. And if I move it to break even, then usually if the price touches the first resistance, after it breaks it, I will move my stops to that first resistance. I already explained that on how to turn a scalp into scalp swings and scalp swings into intraday positions. Let's see another attempt. Okay, good. This is a good example. This is Marubozu candle. Okay, Marubozu candle, and let me adjust it a little bit. So if you watch this kind of pattern, I will show you that this is Marubozu and this is a retracement. Look how. Okay, and now even though if you make your first entry here, your stop would probably be missed for some few pips, but then again you could have made some 10 pips in a profit. There are some examples, and you specifically want to see this pattern. If you see this pattern, this is the beginning of W pattern, and this is usually bullish sign. So if you're in the trade and you see that this pattern is forming, okay, good, take your profits out. You want to risk anything. There are many good examples of those guys. Okay, this is a good example also. Even though this is not a pure Marubozu because it has some wicks. But look at the candlestick. 1550, it's almost 62 pips in itself. That is high volatility candlestick. Look at this. Price went 2 pips close to 61.8, 1 pip, 3 pip, okay. And then it was heavily rejected. So only 61.8 and 78.6 are valid for those kind of trading. Okay? And guys, always pay attention to important support or resistance levels. If you see that, I don't know, just for showcase purposes, this is very close to the resistance, which might be there, well, you can consider maybe not to enter. If you see that there are 15 or 20 pips close to important resistance, because price needs to have a room for resistance. These kind of candlesticks work best. These kind of candlesticks really can work best. So this candlestick is good, and if the price got to this level, you could have made, because there are 25 pips to this candle, and let's say that important resistance is there. So there are more than 30 pips to next resistance. So it's perfectly valid to go. But if you see that there are 5 or 10 pips close to important resistance, then you don't do it. So only if there is a room to next support or resistance. And you can find many good examples on that kind of trading. And this is also a good example. So 25 pips in it, yeah, even more. Then what can we do is to wait for 61.8. Look at this. 61.8 touched 20 pips down. 61.8 touched for the second time, 18 pips down. 78.6 touched. Okay, maybe if this, I don't know, this would be a stop loss. No, it wouldn't be a stop loss, because I usually advise placing stop 5 pips above the high volatility candlestick if we go short. So always use 5 pips. And if you made your entry there, well, 30 pips. So that is how high volatility trading works. Pay attention to important support resistance levels. Put Fibonacci on the single candlestick pattern, which is high volatility candlestick, and trade at 61.8, 78.6. Now, general guidelines. Trading on low and high volatility is not for everyone. Always demo trade before you go live with a particular strategy. Now, if you have any questions, do not hesitate to ask me. Yeah, I can see some questions, so I will answer. Always use adequate money management. I already told you about that. Base your volume traded lot size on your stop loss, not on your possible TP. So that is also important, and you already know that when you trade, you should always base your entry traded on a stop loss, not on your possible target price. Never ever overtrade, guys. Never ever overtrade. Never ever make a revenge trade. And remember the tripod of successful trading. Now, if you have any questions, ask me. Is the current Euro-Japanese 1 hour chart considered Marubozu? How would you take this trade regardless of the coming news? Okay, let me see. Let me see Euro-Yen. What is this? Euro-Dollar. Okay, Euro-Yen. Let me see. Okay, 1 hour candlestick. Yes, this is a 1 hour Marubozu candlestick. Regardless of the news, we want to see a momentum. This is possible entries are there and there, stop loss 5 pips below it. Yes, Adrian, regardless of the coming news, this is Marubozu candlestick. And if I don't, now I particularly told you, if you want to try that on a Euro-Yen, yeah, you can try that. On normal, on high volatility conditions, but on normal days, when there is no FOMC, maybe NFP or maybe less strong, FOMC can be real a mover of the market. I would have taken the trade probably around 78.6. Or if I take it there, I would use third of my maximum risk, and my maximum risk for one entry is 0.5%, guys. So I would use 0.2% here, and I would add 0.3 for a total of 0.5% of that trade. So the answer to a question, yes, it is a Marubozu, it is a high volatility candle, and entries usually are taken around 61.8 and should be taken at 61.8, 78.6. But have in mind that in 1 hour will be very, very, very volatile. So if this was a normal trading day and we had, I don't know, maybe yen news, normal news, then I would take this position here, add there, put my stop loss below this point, and go for maybe a full swing to this point or to this point. But I would use trailing stops, so that is up to you how you manage the trade. 2 days ago is the same. 2 hours ago. Florin, I don't understand your question. Please use English. Florin, I don't know which language you use. I don't speak any language beside English and former Yugoslavian languages, so I don't understand you. Sorry. You're writing maybe in Romanian. I don't speak Romanian. Goran is saying hello. Yeah, hello to you also. Can I view this video later on YouTube? Yes, I will send this video to Admiral Market Support and they will put it on YouTube. Maybe, I don't know, maybe tomorrow. I'm also interested to see how this particular momentum trade would reflect on FOMC. So I would be paying attention to Euro Yen. Of course, I won't be trading this live, but I would pay attention to see the effect of FOMC high volatility candle. So actually, this is a good example to see FOMC effect. Okay, it's the opposite method of trading Marubozu retracement. This is a retracement. This is Marubozu candle, and when you put your Fibonacci, you see retracement. Guys, trading is buying lower, selling higher. When there is high volatility, you need to sell lower, even though this is high volatility candlestick. You need to buy lower. You need to enter the volatility, and you need to buy lower. So this is how you trade retracement on Marubozu candlesticks, which are the sign of high volatile market. Euro dollar today's, I told you to sell 36.30, and if you sold it today at 36.30 first try, you would get 30 pips out of it. If you sold now, I advise you to close your position for 4 or 5 pips of a profit, because there will be FOMC news release in 1 hour and we don't know where the price will go. So if you traded euro dollar by my setup and analysis of last session recap, you could have made 30 pips today, because if you remember my session recap, this was the sell point. You could have made 30 pips, around 25, 30 pips. But if you made it now, if you made it, I don't know, 1 hour ago, you should maybe close your trade now or put it to break even. It's up to you. I would probably close my trade because there is only 1 hour till the news. Goran, answer to your question is not at the moment. No, I didn't have the time. Euro dollar have Marubozu. Yes, this is Marubozu candlestick. Insert Fibonacci retracement. Let's see how it will reflect on FOMC. So 61.8 could be an entry if now it's, let's say that we don't expect FOMC, that there were some big news, and this is where the big news kick in. And usually I would place my trade there or there. But one more add-on, guys, this is important to know. This is high volatility candle. So I think, and I presume, and we all should presume, when this candle appears, that the news has already been done, guys. That news has already been done. Okay, so let's place a trade in demo account. This is demo account, so I don't have to worry about it. Let's place a trade here. It doesn't matter. This is to see how FOMC would fare with this one. $36.12 stop loss. And this is just for demo practices, guys. Don't go this live, please, because we don't know what it will happen. At this point, and this is the example how I do it on normal trading conditions on high volatility, 36.22. So I would place another order at 36. Let's use this 36.22. we are buying, so we need to add a spread, so it's around. So like this, stop loss is the same. 12. And we go for the first price projection. We need to monitor the play. We need to monitor the price, because once this level is broken, it will go to higher resistance. And the higher resistance, let me see, this is it, this is it, this is it, 36.50. So let's see 36.50 and 36.50. Okay, so this is it, guys. Now, this is important thing to remember, guys. Let's say that there was already FOMC in this point. Now, this is only for showcase purposes, guys. Again, I'm telling you, don't go this trade live. This is important to know. This is where the news kick in. After the news or some important data, watch for these retracements, not prior to the news. Not prior to the news, guys. We will have FOMC in less than 1 hour. So, guys, please always take into consideration that this candlestick should represent high volatility during the news or at the news time. Remember this slide. Remember this slide, guys. Everyday high impact news. So if this was FOMC at this point, so let's say that this was FOMC, then it could be good thing only if it wasn't held at 8 p.m. 8 p.m. Central European Standard Time. Let's see that we still have 2 or 3 hours for the London to close, then we can place order there or there. So look for this kind of patterns during London and New York session, just at the news or after the news, not before the news. So this is an add-on which I will tell you, which I forgot to mention you. Okay, this. Now I have some slight problems with PPT. Let me pause the screen and put one more thing. I know it was blocked. Let me try to open it once more, and I will make it an important add-on to the rule. Let me find it. Just please bear with me couple of more minutes. Okay, high volatility. Yeah, it seems I cannot resume this, and even I cannot close this. Well, the important rule is, now guys, please bear in mind, this is again important thing. Do not take the trade before the news. Wait for this candlestick to appear at the news or just after the news, okay? And then trade this candlestick. So if this was FOMC and we still had, I don't know, NFP, FOMC or important news, and there is still 3 hours to trade in London session, then you can go with this and this trade. And now we will have important news, FOMC in 1 hour. So well, this was not a good example. If this was FOMC and I could say yes, then try to enter there or there. But this candlestick was only a reaction to medium important news today and probably profit taking today. Goran is saying thank you. I have just got back from the vacation and I look forward to your webinars and expanding my knowledge. Thank you, Goran. Nice meeting you again. And I know Goran some time ago. We met some 10 years ago, and even in that time I didn't work on Forex market. So Goran is a long time acquaintance to me. Thank you, Goran. So, well, now you know what you should do, guys, when you want to trade high volatility. Now you see this was, I cannot close it, so it's frozen. But the important rule is that. So write it down. Again, I will say that, and I will finish with the webinar because I can see that there are no questions. So always, always, always pay attention to high volatility candlesticks at the time of important news, important volatility, not before the news, such as this example today. And you can trade it after it has happened, or at the time it's happening after big news, big volatility shifts. Now, if there wasn't FOMC, and if there was 3 or more hours to London close, we could try to enter there or there because the risk is really small. Okay, also, Claudio, have a great evening, great webinar. Thank you. Okay, thank you too. Guys, pay attention also to soccer today, football, because today there will be important event, Argentina versus Holland. Yesterday we saw Brazil versus Germany and Germany. That was really absolutely brilliant match. Germans really, I like how they play football, and unfortunately Brazil was an epic fail. And let's see today what will happen. I don't know who will win. Maybe Holland, but also Argentina is great, so we will see. So guys, don't forget it. Then don't forget to watch football, of course, and pay attention to FOMC. So tomorrow we will have other setups, and I hope that market will pick up tomorrow so we can have even more pips. Thank you all for attending. I wish you a great evening, and cheers and relax. Bye-bye. Talk to you soon, guys.